Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence.
Today's video lesson and topic is explaining basis. This is our second video on basis, so we're going to review basis again, but this video is really about basis in time versus basis in space. So our topics today include just a review and a definition of basis, explain basis in time versus basis in space, and then we're also going to define cost to carry, when and how to take advantage of it so you can make a little bit more money. Our first topic today is reviewing and defining basis. Basis is the difference between the local cash price and the nearby futures price. Most farmers understand that. It relates your local cash price to the futures market. Basis is important in pricing decisions because part of the return is always the local cash price. Understanding the relationship between the cash and the futures market, therefore, is an important element of a risk management strategy. Remember, futures is your biggest risk, not basis. Corn futures can drop from $7 a bushel to $3 a bushel, but your local cash rarely, if ever, has made such a wide move. Our second topic today is comparing basis in time versus basis in space. A major function of the pricing systems allocate the product across the storage time. There are two components: basis in time at the delivery point, such as Chicago, Saskatoon; basis in space at a non-delivery point like Illinois, Italy, or Europe. Our third topic today is defining carrying costs and how to take advantage of cost to carry by using examples. In a well-functioning market, delivery point basis equals carrying costs. Similarly, the spread between futures months within the annual storage period equals carrying cost. Carrying cost is mainly the interest cost to carry the grain over time, should also count for shrink. Basis rises as that carrying cost increases. So in our slide example here, we're assuming that bank interest rates is 5%. We got cash value of $6 a bushel. We got a storage cost of say 4 cents per bushel. There's an interest cost, some shrink. We come up with a monthly storage cost of 7 cents a bushel. So each month would have to have a spread of 7 cents to allow for the farmer to cost to carry that grain over time. If it's not more than 7 cents, then the market is saying do not store into the future, sell me the bushels today. So let's use Chicago wheat as an example. The spread in that slide that you're seeing right now from July to September 2011 futures is 49 cents per bushel, and the spread from July to December of 2011 is 98 per bushel. This is more than enough to compensate a producer to store for 2 months at 14 cents a bushel. Again, you're multiplying the 7 cents times 2 months, or for 5 months. If we multiply, 7 cents times 5, that's 35 cents. We got some big spreads here. This is your cost to carry. This is how you take advantage of cost to carry. It's rare, but when you see this, you need to sell out into the future and get the market to pay you to store that grain. In this situation, a producer would take advantage of the cost to carry and make the market pay him or her to store that wheat until December of 2011. However, if you have storage, the producer who has storage could also go out to December 2012 with a 153 per bushel spread and book forward and lock in that cost to carry with your local elevator. Alternatively, a producer could put on a spread. This gets a little bit more complicated, but the spread is where you short December 12 futures while going long on nearby futures, hoping that that spread, that cost to carry, that 153 per bushel, would narrow over time. In our Minneapolis wheat futures example that you're seeing up front here, we have an inverted market as the front month futures are concerned about quality milling wheat supplies and therefore driving prices higher to ration demand. The spread from December 11 through to July of 12 is only 0.008 per bushel. Very little cost to carry. A producer in this situation would sell 2011-12 new crop hard red spring wheat bushels in September or December of 2011, not stored until March or July of 2012. Again, there's no cost to carry, there's no advantage, the market's not paying the producer to store that wheat into the future. In our corn futures example, we have an inverted market again for old crop corn 2010-11. The front month futures are higher than the deferred future contracts because the market is very worried about having enough bushels to meet demand. Prices are higher in order to ration that demand. However, for new crop 11-12 corn, the spread from December 11 to July of 12 is only 23.8 per bushel for 6 months worth of storing, not worth storing. Again, the market's not paying you enough to store that grain into the future. If the cost, so in this example, it will cost the producer 42 cents per bushel to store for 6 months. Therefore, the market is advising the producer to sell in December of 11, not store it until July of 12. There's a cost to carry, but not enough to compensate the producer to store. In our canola futures example, the spread from July 11 to November of 11 futures is $2.90 per metric ton, or just 6.5 cents per bushel. The spread from November 11 to July of 12 is about 40.5 cents per bushel, or 17.80 per metric ton. Still not enough to compensate a producer to fully store for 7 months at a cost of 49 cents per bushel. In our soybean futures example, we also have an inverted market similar to our corn example. The July 11 soybean futures are higher than November 11 futures as much as 15 cents per bushel as supplies remain tight. The spread from November 11 to July 12 is only 0.012 per bushel. Once again, futures are not advising a producer to sell soybean bushels in November of 2011, not to store until July of 12. Again, the producer would sell in the nearby futures months, not into the deferred months. I hope you understand. I think you're getting a drift of what's going on. So when you have that big spread out into the future, that's your cost to carry. Take advantage of it.